We start today with a signal straight from the Federal Reserve's own intelligence network, and it is flashing amber. The Fed's Beige Book, which compiles anecdotal economic reporting from all 12 regional Fed districts, delivered a nuanced and frankly sobering read on the American consumer this week. Yes, the World Cup soccer tournament delivered a genuine, measurable lift to bars and restaurants across multiple regions. But here is the problem. That hospitality sugar high is not spreading into the broader economy, and the Fed is explicitly calling it out as isolated rather than indicative of durable consumer momentum. The Federal Reserve's Beige Book, released this week, confirmed that World Cup activity created a temporary tailwind specifically for bars and restaurants, with multiple regional districts noting increased foot traffic, higher tab sizes, and fuller reservations during match days. However, the same report is careful to characterize these gains as isolated. They are not transmitting into discretionary retail, entertainment broadly, or services outside of hospitality. Meanwhile, the VIX has spiked to 18.25, up 9.68% today, and the 10-year Treasury yield sits at 4.6%, up 0.63%. Markets are already pricing in growing uncertainty about the consumer spending trajectory heading into the second half of the year. Consumer spending accounts for a substantial portion of U.S. GDP, which is why a Fed qualitative survey showing demand deceleration is far more consequential than a single retail print. The Beige Book's warning is particularly pointed because it arrives at a moment when markets have been banking on consumer resilience to justify equity valuations near current highs. If the consumer is wobbling despite the artificial boost of a global sporting event, the organic demand backdrop is weaker than headline numbers suggest. That structural deceleration argument is exactly what bear case macro scenarios have been built on for months. The tickers most directly in the crosshairs are consumer discretionary, the Consumer Discretionary ETF, and XRT, the Retail ETF. Both face genuine headwind if the Beige Book's cautious tone is validated by hard spending data in coming weeks. The Russell 2000, tracking small-cap, domestically exposed companies, is reflecting weakness among small caps as they feel consumer pressures most acutely. The S&P 500 and the Nasdaq 100 are trading lower, while defensive positioning in utilities via utilities and consumer staples via consumer staples becomes increasingly attractive, as does the long-duration Treasury trade if rate cut pricing accelerates. There are three levels every macro-focused trader needs to own right now. First, the S&P 500 support at 745. A clean break below that level on volume would confirm the consumer weakness narrative is being priced into equities structurally, not just as noise. Second, the Nasdaq 100 at 700, a major round number technical support that would draw significant attention on any continued sell-off. Third, and most critically, the 10-year Treasury yield at 4.6%. Watch for a decisive break below 4.50%. Which would signal that bond markets are pricing in a more aggressive Fed rate cut cycle driven by deteriorating demand. The 5-year yield at 4.41%, already up 0.85% today, adds steepening pressure that complicates the Fed's calculus considerably. Here is the cleanest way to frame this story for your portfolio. The Fed just told you, through its own distributed intelligence system, that the best consumer catalyst of the summer, a once every 4 years global tournament with massive viewership and spending potential, produced only a localized blip in hospitality, not a broad economic acceleration. That is a red flag, not a green light. The actionable takeaway is straightforward. Rotation into defensives like utilities and consumer staples, and consideration of long-duration treasuries, is warranted until hard consumer spending data arrives and either confirms the Beige Book's concern or credibly contradicts it. That is the one story driving macro sentiment today. Full breakdown is up. If this kind of deep dive analysis helps you navigate the market, hit subscribe and turn on the notification bell. We break down every major macro story every single trading day, so you never miss a move that matters.